Yeah, you, real estate investor. Hey, let me ask you a quick question. How much money could you make if you had access to an unlimited amount of capital to acquire your real estate with no credit check, strictly asset-based financing, and quick closings? My name is Liddell Buggs, president of 316 Cap. We are a residential and commercial real estate finance company. Click on the link below or swipe up to have someone from our staff contact you to assist you in closing your next real estate transaction.
Jesus gave us that job description, man. So get busy. Yeah.
We on the grind and we ain't gon' stop. Crew said we on duty like them plain clothes. Caps we ignited in us fire, much flame so hot. We was lame, dumb slaves, we was plain robots. Ever since we been clean out of stain.
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, y'all? It's your partner, Dale, looking oh so fresh, cold, clean, y'all. You see that thing. Now, while you can, because I always look better than you, take that damn picture and give it to your mom and them guys. And welcome to Real Estate Live, guys. It's going to be your partner today. Cliff is taking care of some business for us, y'all. So it's going to be your partner, me, myself, and I. It's okay. Just accept the finest of what you see, guys. And I want you guys to welcome you guys to Real Estate Friday. We're going to talk about a very special topic today, guys. We're trying to make sure everything's good to go on our platforms. We're doing something a little different today, and I actually like it. One sec here, guys. Boom, here it is. So, but y'all, uh, in real estate, things change a lot. And what I wanted to kind of talk with you guys about was a certain space, but you know how we always begin this thing, guys, with the ever changing economy. When things begin to change, you're going to have to really look at what's going on in today's week and then adjust on the fly. And so today we're going to do that as well. So we have to go back to our guys from Valuetainment. We're going to revisit the SVB collapse. The reason why is because of the fact that the Fed Chairman Powell said some things that was profound, and you guys got to hear what he actually said. And this is going to tie right in to what we're going to talk about today. So if you could, guys, grab your pens and pads very quickly, and let's get into the thing. Let's go, guys. Here we go. Let's see what he's talking about.
Let's go into the Silicon Valley Bank story. What do you think is going on there, and do you think it's the end of it? Obviously, yesterday Powell came out. A lot of people didn't think if he's going to increase interest rates or not.
Right.
Is this guy going to do it? Is he not going to do it? It's not a good time to do it. Maybe take a break for a month or two. We're seeing what happened with Silicon Valley bought a 10-year bond for $100 billion at 1.7%, thinking they're going to make it.
And while he's talking about that, guys, remember what he started out as. He started out talking about how in the world, he talked about the Fed chairman raising the rates, guys, a bit, and we're just going to pause as well. He also talks about what SVB did as a bank, which was really stupid what they actually did, buying a 10-year bond at a 1-2% rate, knowing that the Fed chairman said he was going to raise the rates. I want you guys to pay specific attention to the raising of the rates. We're going to talk about that here shortly and how it ties into today's topic. So listen very clearly. Here we go.
And then bam, they have to sell that for some $20 billion, and Depositors are afraid. Those below $250,000, which is a small percentage, whatever the number was, 3%, they're covered. But the ones above, everybody's coming and saying, we got to bail the depositors out.
Yeah.
What are your thoughts about what's going on with Silicon Valley?
Well, there's a couple of different issues. I mean, and you can sort of go down the line.
Yeah.
The biggest issue is that in 2017, the Trump administration, the Republicans, and with some corporate Democrats as well, basically rolled back the regulations that were required for banks like SVB. It used to be if you had $50 billion worth of holdings as a bank, you were subject to the Dodd-Frank requirements about capital to keep the bank safe.
Yeah.
And that would have also come along with like sort of subsidiary regulations and regulators being there to make sure that you can't make stupid decisions like that. I mean, they made some very stupid decisions that were people involved in banking could take issue with, assuming that interest rates were always going to stay low, whatever.
Sure.
The point of regulations like that, where you take more or less a meat cleaver and you say is that people can make stupid decisions, but we're going to be here to protect the system and the depositors. The other thing that was going on there.
Right there, guys, he talked about how they're trying to protect the depositors. The key thing is how are they protecting the depositors, guys, okay? And that ties right into the Fed rate. Listen to what they're saying, and I'm going to tie that thing in here in a second, guys. Hang with your partner. Hold on.
There with all the depositors that had all this other money, this is a kickback situation. There's no doubt about it, right? Because anybody with $251,000
So,
cash knows that there is a $250,000 FDIC limit. And if you're putting $500,000 in there or billions of dollars in there,
listen.
you're getting something from the bank in return, which is low-cost business loans or like 0% mortgages. I'm sure you run into this. You put your money into some big, investment bank. You're getting kickback. You're getting a 0% mortgage.
Yes, sir.
So you go out, buy a $13 million house. You don't have to pay anything for that money. You keep your money in a CD. And you're making money off of that $13 million house, essentially, that you bought.
Yeah.
Because you've just got that money borrowed cheap. And if they're going to do that, I mean, look,
Listen.
to each their own. If they're going to do that, they need to pay the consequences.
Now watch this, guys. He talked about a CD, right? Talked about how if the FDIC is $250,000, right, which is fine. Anything over that, the FDIC initially was saying that they're not going to cover that, right? So if someone puts anything over $250,000, he talked about how anything like that they put into a CD. And when someone puts money over that threshold of $250,000, they're getting a kickback or something or an incentive by the bank to do that, i.e. a lower interest rate, i.e. a higher rate of return when it comes to the CDs. Here is the thing that people are missing concerning the SVB, the Silvergate, the Credit Suisse, things of that nature. Here's what they're missing. A lot of these banks, like for instance, SVB, what they did was they bought a lot of these government bonds or treasury bills at a low interest rate, 1 or 2%, right? Knowing, which was kind of dumb on their part, that the Fed was saying he was going to raise the rates on those treasury bills, on those new treasury bills, and also government bonds, guys. All right. So they bought these 10-year bonds, dumb as hell to do, at a 1 or 2% rate, maybe even 3% rate, knowing that the Fed chairman said he was going to raise those rates even more, right? So when he raised those rates, what actually happened? They began to be underwater, right? And so when they were underwater, what actually happened is now SVB had toxic bonds on their balance sheet, and they had to turn around and sell those bonds at a fire sale. People began to hear that, and then people began to, of course, withdraw their money out of their bank. And so here's what I want you guys to focus on. These banks are buying treasury bills and government bonds. The question you need to begin asking these banks are this here. When did you buy those treasury bills or bonds? And how long was the tenure and at what rate? Right? That's what you got to get realistically do, because the Fed was talking about raising rates. Here's the key thing about when it comes to the Fed chairman. He did say, I believe a week and a half ago, I may be wrong on the time frame there, that what he would be doing is He would be raising the rates, I believe, one more time in May, and then he was going to pause to see what is going to break. The key word there is to see what was going to break, right? That's what's going on. So I wanted to revisit this whole thing concerning SVB and the other banks, because you saw Silvergate failed before SVB, then SVB, then you also had Signature Bank, then you also had Credit Suisse as well. Also, Deutsche Bank began to kind of, their stock began to kind of shake a little bit as well. So you're hearing a lot of rumblings in that banking sector. All right. And so, how is that affecting what we're going to talk about today? Well, guys, let me take this off real quickly here. Let's dive into this, guys. The question we got for today is how to purchase apartments in today's economy. We're talking about class A, B, C, and D. All right. How to acquire apartments today in today's economy. Now, Liddell, why? So, what's going on in the apartment space? One of the biggest investments that banks actually have, okay, is their commercial paper. Their commercial paper, a lot of that paper is in apartment complexes, guys. It's in apartment complexes. Newsflash, Cliff told me this as of yesterday. He said, Liddell, 75% of the apartments are in trouble. Let me say it again for the folk in the back row. 75% of the apartment complexes, A, B, C, and D, are in trouble. That is a big issue. Why is that? It ties right back into what banks are buying, which is these treasury bills and these government bonds. The treasury bill and the government bond sector is collapsing. It is crashing. It is failing because a lot of these banks and these fiduciary companies that buy these government bonds, because a lot of them buy them in 1, 2, 3, 4, 5, 10 years, which isn't making sense to me at all. Anything over a 1 year time frame on a government T bill didn't make any sense to me at all, because the Fed chairman said he's going to raise the rates. So why would you buy a longer term government bond or treasury bill or T bill? That's what they call it, okay? So these apartment complexes are in trouble. How do I know? We are getting a ton of people calling us to unload their class A, B, C apartment complexes. We don't look at any Ds, but A, B, and also C plus apartment complexes. And a lot of these apartment complexes, guys, are on college or university campuses. Let me say that again. A lot of these apartment complexes, and if you pull up to them, they look wonderful outside. But if you go behind that front door, that veil, it is a train wreck on their books. A train wreck because they've been mismanaged so badly, guys. Mismanaged so badly, guys. So that's what's going on in the commercial space. Is the commercial space is in trouble. If you go over to the office building or warehouse sector as well, also that's part of the commercial space, just like apartment complexes are, but they're called multifamily. But they're still on the commercial paper when it comes to the bank, right? I believe they're typically in the commercial space, the office building and the warehouse space. You really like a 12-month inventory time frame is kind of a good rule of thumb. Guys, they're between 36 months and 48 months in inventory, which means no one is buying those type of investments. Nobody is. Nobody. Do you see why there's another remnant going on in the banking sector that no one's talking about? Because the commercial paper is crashing, right? Do you see what's going on now? So there's no need to scare. That this is an opportunity for you. All right, here we go. Let's walk through this thing. How do you begin to invest in apartment complexes in today's economy? The same thing. The same three parameters, guys. Insure, leverage, and protect. Let me say it again. Insure, leverage, and protect. It's real simple. All right. Number one, insure. What's the best way to insure any type of real estate investment is in your negotiation. All right. You have to be a negotiation hawk now because you have opportunity now because you have mismanagement on the table now. Right? Mismanagement on the table, which means from a condition standpoint, from a leasing standpoint, right? From a property management standpoint, all that is in play here when it comes to apartment complexes. All right, guys. So in negotiating, to me, this is probably the most powerful strategy you can use as you're negotiating. And right now, I'm doing this with a lot of my partners. Right? We are doing this type of strategy. Joint venture a strategy, investment strategy is pivotal because those class A and B properties are normally $1 million and above, right? 1 million and above. Typically, a lot of investors don't have the cachet or the balance sheet or the credit profile to go after those class A and B properties. All right. You want a joint venture strategy scenario to begin to acquire these properties, guys. Give you an example. Grant Cardone is known as a apartment complex investor. He's very good at it, extremely good at that thing, right? He goes after Class A buildings in major areas. That could be a good strategy if you know what you're doing, right? Last year, right here at the interview, he said last year he walked away from all of their real estate investments back then. Why is that? It was because of the fact that he saw what was going on the commercial paper side when it came to apartment complexes. So he actually walked away from those transactions and also lost money on those deals because he let the deposits go. Whenever you go actually buy an apartment complex, you got to put down a earnest money or a good faith deposit. He did that, and then because the properties were not in such a good condition, and what they were asking for was too much compared to how it was operating, he walked away from those transactions and lost the deposits. This is real, guys. And he owns $5 billion worth of real estate. Actually, it's probably around close to $10 billion now. Real simple, guys. This ain't hard. All right? Don't get scared. It's an opportunity. That's why joint venture investing is so pivotal, because you can bring in someone like myself or another investor that you may know that has the cash, the credit profile, but they lack the intellectual capital, all right, to be able to acquire these type of properties. That's when you walk in, bring the deal, or again, the deal attracts the resources with a strategy to acquire as well as manage that thing the proper way, guys. The biggest thing when it comes to acquiring is being able to negotiate from a strong standpoint, right? So that's why a joint venture strategy is key when it comes to negotiating or ensuring your investment. The lower you can buy it at, realistically, the better deal, because of the fact that you can actually set yourself up for the correction. There's not a crash coming, there's a correction coming, and that correction is going to be very severe. Negotiation with a joint venture investment strategy puts you in a powerful position. You can walk away from deals knowing that they'll come back to you because of the fact that they believe they can get a certain price point, but because of the condition of the property and as how it's operating, you can walk away and they come back. Guys, they always come back. They always come back. They'll say no up front with your initial offer, but they always come back because they believe that they'll get a certain price point and they won't. And guess what's in there? And now when they come back, you can begin to be a little bit more hawkish on your negotiation and get a deeper discount. I promise you guys, we're doing that right now on about 4 apartment complexes right now. And these are Class A apartment complexes that we're buying for damn near 50 cents on the dollar on major university, Division I university campuses. We're doing that right now. So this ain't no theory. This is what we're doing right now. All right, guys? Number 2, again, be patient. Be consistently patient so that you get the proper leverage. The deeper the discount, the aggressive the negotiation, the more favorable you can get on the leveraging, right? The deeper the discount, the easier it can be to get the proper leveraging that you need to do this, to do the third thing here. So again, you got insure, then you have leverage, right? And then the last one, guys, is protect. When you negotiate right, get the proper leverage, The lending part is easy because it makes the deal appealing to the bank. Think about it. If you bring a deal to a bank, right? Let's just say, for instance, the apartment complex is worth, I'm using big numbers, guys, $20 million, right? $20 million, right? So now you use $20 million. And the ARV of that thing is about $25 million, right? And let's say, for instance, they want $18 million for the deal. Terrible deal. Horrible deal. That makes no sense to me at all. What I would do is I would be consistently patient, focus on the negotiation, and most likely you get that property from not 18, probably around like 13, 12. I ain't lying. 12 million. I ain't lying. Because no one's coming to buy those. No one's coming to buy them. All the money is parked on the sidelines, which means the opportunity for you. Do you see why ensuring, leveraging with a joint venture investment strategy and protection when it comes to lending is so pivotal? Because you have the intellectual capital to properly negotiate, get the proper leverage, and with the joint venture partner, get the proper lending that you need to take down that property and get that you need to actually increase the value by actually upgrading what's going on so that you can then charge a higher rate with rent. You buy, renovate, refi long-term debt, guys. And when you refi the long-term debt, because when he actually raises the rate one more time in May, there's going to be a correction and he's going to lower the rates. Guess who benefits from that? You do. Because now you can refinance to a lower rate. You said this thing works? You said it works, guys? It ain't that hard. It's very simple. All right, guys? So let me give you a real world study real fast, guys. And this is what we're doing right now. Right now, guys. We're looking at a property on a major university right now. And it's 3 different properties. It's about 850 units. About 280 something units a piece. 283, I believe, which is good. They wanted about $80 million. I laughed at them because the property at the time is 50% occupied, and it is dilapidated in its condition. It's updating. No one is going to buy. Initially, guys, they said no to our initial offer. I was consistently patient, as we says right here, right? Guess who came back to the table? The same sellers. And now what's happening, guys, is I get a deeper discount. And also, we actually structured a transaction to where we can even joint JV with them as well, so that we get a deeper discount. So we got even more creative in our negotiation, which would drive down the price point, which would then allow us to buy the property at a deeper discount, which we can get the proper leverage, right? So we got insured, leverage, and the proper protection, and the lending is easy. Easy work. Because we have the intellectual capital and the good team to be able to get this done. A good friend of mine named Harvey up there in Michigan is spearheading this for us. And in that scenario, guys, we're JVing together on this deal. Oh man, there's so many. We got another deal also in Louisiana that we're talking about. 10 property portfolio and 14 property portfolio. Did the same thing. The seller was BSing me and Cliff. Me and Cliff negotiated like hawks. Now he wants to come back to the table and negotiate more. Now we get at a deeper discount. These are the opportunities that are on the table right now. If you do this strategy, guys, real simple, is you insure, leverage, and protect. Negotiate, guys, all right, with a joint venture strategy, right? Consistently stay patient, right? And then that would attract the proper lending you need to execute at a high level. Guys, it's real simple, guys. So I hope this helps you out, guys. Also, guys, real quickly here, we dropped this as of yesterday, guys. A good friend of mine, his name is Aaron, actually asked if we actually could help people locate distressed properties. All right. Do we have strategies from how to attract those properties, as well as how to market to them to get them under contract and to buy those properties. And he said, Dad, you have something that can teach us this. Guys, as of today, we are dropping a course called How to Locate Distressed Properties in Today's Market. Guys, we go over the marketing strategies that you need, right? Go over strategy that you can actually implement by actually calling down to your local city government and get distressed properties, sometimes even for free or a little bit of a small fee, right? And also, we also give you access to our cash flow analyzer. Cash flow analyzer, guys, which is this is a spreadsheet that we use to vet every single deal that we do. Guys, this entire course right now, I'm teaching it. $97 for the entire course. Marketing, locating the properties. We actually go over how you can, once you locate the actual distressed property, we even give you strategies on how to even market to them, talk to them, get them on the phone line, and close the transaction. The entire blueprint is right there, $97 for the entire course. $97. That's it. So a friend of mine, Aaron, asked us if we could do that. We did. We're dropping it today, guys, which is pretty good. We're doing a pretty big social media push on this one as well, guys, because this gives you the blueprint on how to get that accomplished. Because right now, whenever there's some volatility in the market, opportunities are right here, guys, and there are so many opportunities on the table right now, guys. So yes, on Instagram, yes, that's correct. $97 total. That's it. Total. You download the cash flow analyzer. It's yours. Use it for anything you want to use. We use it. We still use it to this day. Whether it be us actually buying a single family residence, apartment complex, or a commercial building, or new construction, we use that exact same cash flow analyzer. It's yours. $97. Yep. And it's video training. And we walk you through everything. We talking about, I show you what to say. I show you how to market. I show you where to go and actually do what I call guerrilla marketing, low budget guerrilla marketing. I show you how to do it, what to say, how to say it. I even let you know actually who to call in your local city, town, or county to get a list of distressed properties. Yes, that's in that training, $97. Total. That's it. So, guys, I hope this helped you out, guys. It's real simple. If you want to get the training, guys, just scan the QR code. If you're on Instagram, it may be hard for you to do on Instagram. Just go over to my YouTube, which is right there, guys, and you can scan it right there. $97. That's it. That's it, guys. So, guys, I hope this helped you out a lot. I will be posting this course as well on all our platforms as well later on this evening. It'll go live and there'll be a link there for you to click on there and just go to it, guys. Real simple. Our whole goal is to make it easier for anyone at any time, at any educational level, to be able to invest in real estate. Sometimes if you don't have any money, it's okay. That's why joint venture partnerships are so key. So key, guys. All right. And if the deal works well, guys, me and Cliff and Jason will actually partner with you and bring the money to the table. We're talking about to acquire it and to renovate it. And we'll do a joint venture partnership private split with you. Yes, sir. So this ain't no theory. It's what we do all day long. That's how we got those three apartment complexes in Michigan, guys. Harvey found the deal. Harvey's been killing it. Found that deal. Dale, I got a deal. We walked through the numbers, begin to negotiate on those three apartment complexes, 850 units total for all three, right? And we want to get them for down to 50 cents on a dollar. Mm-hmm. Yes, sir. Yes, sir. So the guys, they're out there. But guys, I hope this helped you out, guys. I hope it really did, guys. If you have any questions for me at all, you know I'm a DM away. This is on Instagram. They said learned a lot today. Thank you. Oh, thank you so much. Stanport Sounds had been waiting on this one. Thanks to now the problem with it all. I hope it adds value to you. And guys, if you need to know anything additional, guys, let us know. We want to make real estate very easy to learn and how to do. And the reason why, guys, is because I didn't have a mentor growing up when it came to real estate investing. I had to learn really kind of going through the motions. I learned strategies, but I had to kind of lose some money to make some money. And so for me, if I can help you not lose money to make money, and if you need me to partner with you, I'll do it. The deal has to be good. It has to be good, guys. All right. And so, guys, thank you so much for your time. God bless you. I hope you guys have a wonderful weekend, and happy Easter to everybody as well, guys. Christ is King and Lord. So, guys, you know I end everything else, guys, every single week. And Cliff will be on next week, guys. He's taking care of business for us. All right. So before you leave, and while you can, you see that thing, because I look better than you. Now take that damn picture and give it to your mama them. Now say it with your chest and holler at your partner. God bless you guys. Have a wonderful weekend. Peace.
I give thanks. Bless God.